Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. We are entering a new trading week and we are coming off of a very active concern of general risk aversion. There's a lot of talk about the emerging markets, there's a lot of talk about financial crises and how we could evolve into something far more prolific. The memory in the market is not so short that we can't easily recall what happened back in 2007 and 2008. But are we really going to get that risk adverse that quickly? All right, that's a question that I think that we have to answer this week because I do have a significant round of event risk on my docket, and the market is going to be playing it step by step. So today's strategy video is going to be the pace of escalation for risk aversion. All right. So the first thing I want to start with is the fact that we did have some level of moderation into this new week. The S&P 500, one of my favorite benchmarks for risk on, risk off. You can see that the session ended in something of a doji, a very remarkable candle that is often associated to potential reversal. I would not call this a reversal. All right, you must be very cautious in making those assumptions because you're turning or trying to play against major momentum. And oftentimes we call that picking tops and bottoms, which is a fool's endeavor, as the saying goes. So it's not saying that it's not possible that we have a bounce from risk, and this is the depth, the extent of our retracement, but it certainly does suggest there's some level of moderation. That moderation is going to be mirrored in many other asset classes. The Japanese stock index Nikkei 225, you can see that leveled off a little bit, hitting some very noteworthy support here on this trend line. We have similar conditions in European equities, and obviously I look at equities in general as a overall asset class. But we can also see the same kind of conditions in the FX market. The Euro USD is remarkable because it did not actually have a deep retracement. All right, this speaks to actually the depth and of severity of risk aversion, and really suggesting that we have not yet hit an extreme move towards risk aversion. But those pairs that were sensitive to this, the dollar, yen, and really all the yen crosses, we're having candles like this. This is an 8-hour chart. We have the euro yen, similar situation. All right, they tentatively broke head and shoulders pattern necklines, but there is some bounce and some moderation. Here's the daily charts on the higher yielding carry trade yen-based crosses. The Kiwi yen, CAD yen, and Aussie yen, all daily charts. Now, as you can see, there's a little bit more aggressive of a bounce there, and there's certainly some significant level of moderation when we look at the performance of these yen crosses. When we were watching the source of our fears through Friday, a lot of it was tied into, obviously, the emerging market. All right, this is the Emerging Market Volatility Index. Now, this Emerging Market Volatility Index is certainly going to generate a lot of concerns for us. I wanted to kind of differentiate between a concern specifically of emerging markets, an isolated, not necessarily isolated because it's very contagious when you hit a big segment like emerging market, but I want to see how easily it's transmissible through not just this one section, but the entire risk spectrum. All right, so I wanted to search sentiment for these various, or at least concerns for these two different concepts. So what I did was I searched search popularity or traffic for the two different terms. Emerging market traffic through Bloomberg, and this is how much attention or how much coverage has been given to this specific term. You can see it has surged. So obviously that's our trigger for risk aversion, for broader risk aversion if it were to take root. But you can see that there has been a severe concern here, just like when back in August when we had the Indian rupee story, there was a big pickup in emerging market concern as well. But how about general crisis? How concerned are the markets about the general crisis level in the markets? Well, as you can see here, it's picking up, but it is certainly not the same level of concern, the same level of fear. Now, I've made this, and I put this on the real-time news feed. I have a measure of risk, all right, how severe risk aversion is And it's on a scale. All right, so the lower we are on the scale, the lower the sense of risk aversion, and the higher up, obviously, the more risk averse the market is. And the market impact obviously changes from low to high. Now we have, at the very low end, few volatility events, a few pickup in volatility figures like the VIX, or maybe a pickup in volatility for something like the emerging market volatility index, but nothing that is consistent. Correlation across those markets would be relatively low. All right, we move up and things get a little bit more frequent. Volatility events become a little bit more often, and there is an increase in correlation. We start hitting the curve in a serious way when there is a concerted unwinding of riskier assets and there's a moderate correlation. All right? I think this is where we're at right now. When we get to high level correlation and all things deemed risky are unwound, that's when we start to really hit the severity of risk aversion. We're not there yet, but this would be the next step. And of course, the conditions get really tense, really taut when we have a funding problem, when liquidity starts to dry up, and things like overnight cash rates in the most liquid markets become very expensive. All right, that is a severe situation. That's when central banks start stepping in and working in a coordinated effort. We're far from that just yet. We're still somewhere in the middle here. All right, but I want to look at the timing of this. Is it possible that we move up this curve this week? Absolutely. Absolutely. There's always an opportunity that happens, and the easiest way to play or cater to that kind of concern is to see a unwinding of riskier assets, which is not difficult to do when we know that we're built up on leverage, or when we are considering the relationships between volatility and capital markets. Of course, we also have to consider participation in volatility, all right, hand in hand. So we need Catalyst to really, or we should use Catalyst to kind of benchmark the pressure points when we have an opportunity to realistically see a jump in fear or a jump in risk appetite, the opposite direction. And we do have notable event risk. Obviously, the opening 24 hours of the trading week was low-level event risk. So there's fewer instances here to unify all the market's concerns, to concentrate us all on one fear. All right. Now, there's always a possibility that you just get a windfall or waterfall catalyst of just hitting a ton of stops. That often happens during severe sell-offs, but it doesn't seem like it's happening just yet. And one reason that might not happen, and the market may wait for confirmed catalysts, is because, yes, we have the upcoming session, some important standout events, the European Union Finance Ministers meeting, the UK GDP figures, very important, consumer confidence, obviously, in the United States, but a lot of the market is going to be looking forward to what happens here on Wednesday, the FOMC rate decision. Will the Fed defer its stimulus program, or its pullback of the stimulus program? The taper, in other words? They might not. It's unlikely that they do, but there might be a reason for people that are concerned and that are starting to unwind their positions to hold off. On the outside chance that they do not follow through with more tapering, more reduction in the QE3 program. So you can see here indicated in the red, there is a time frame for what we are looking for, and there's reason to give investors, traders, pause. Now, fear is by far the most pervasive and the most explosive emotion when it comes to trading. Greed being on the exact opposite end of the spectrum is nowhere near as volatile as fear. If fear kicks in, traders don't need a reason. They just need to have concern that they need to protect their money. Right? They don't have to rationalize. They just unwind. They just sell. All right? So you have to be very careful about the conditions that we have here, the timing. So while we may see the market wait until we get to the FOMC rate decision on Wednesday, there's always a possibility that risk aversion turns into fear, and fear turns into full-scale deleveraging. That would be a clear view for something like the S&P 500 or something like the dollar yen, but it is also, in the FX world, good for the US dollar. And that's actually what the dollar is looking for. So keep this in mind as you watch the headlines cross, and there are some very bombastic, very lights flashing headlines, but be realistic about the time frames and be realistic about price action. All right, we'll do another Forex strategy video tomorrow. Until then, good luck trading out there.